Small caps are really showing that they can kind of punch the weight with the large cap names. That's faded over the last few days. Does that continue?
Well, thanks for having me. I think from here, what's going to matter is earnings. So our view has been that, one of the necessary conditions for the Russell 2000 rally was that we could see more confidence in inflation slowing and more confidence that the Fed will be able to cut rates. That happened a few weeks ago and was a big driver of the rally. But I think now the other thing we're looking for is confidence that fundamentals for small caps can improve. And I think a lot of investors are looking at the earnings story because back at the start of the year, analysts were expecting that by this earnings season, small cap profits would have recovered, would have been very positive, would have been outpacing large cap profits. And that hasn't happened. The numbers have just continued to be cut. And this earnings season, it's been relatively weak for small caps so far. We still have a lot more reporting to go, but we're seeing, much fewer beats, much weaker guidance than in large caps. And when we looked at corporate sentiment on earnings calls, we're seeing so far this record negative spread between small cap and large cap corporate sentiment. So I think until we can see the fundamental trends turn around, the small cap rally is likely to, to pause from here. But if we can see the fundamental shift that gives us confidence in that very back-end loaded earnings recovery, then the rally could pick up again.
It'll be interesting to see if that happens. I mean, we're already worked our way through about half of the Russell 2000 in terms of earnings reports here. So we'll see if that other half actually shows something different. I am curious about the correlations to the macro economy, to the economic conditions. That is, there was a lot of talk here about that if you do think we're in a recession or at least headed towards a slumping economy of some degree or another, that small caps have a higher correlation than some of those large cap names. Are you finding that holding?
Yeah, I mean, I think, we've looked at the correlations of small caps to macro data and to various indicators. The ISM manufacturing indicator is still one of the most correlated indicators with not only corporate profits overall, but with small versus large cap relative performance. So we've obviously seen several weak months in the ISM. Macro data, we do continue to expect a soft landing in the U.S., but, typically these, when we look at different macroeconomic regimes, we've been in a recovery regime since earlier this year. Last year, we had some weakness. We had an earnings recession in the U.S. Small caps typically do well coming out of that and when profits recover. But now, obviously, we're watching a lot of the macro data. And if it were to start to weaken further, then, in those macro downturns, that's typically a period where you want to own quality and larger caps.
Right. So, Jill, if we sort of get through this soft patch, do we revert back to the rotation trade that we were all talking about, 10 days ago in terms of sell tech, buy small caps?
I think broadly, we have expected a rotation in the market, particularly within the S&P 500 out of the Mag 7 and into the other 493, and that's where you are seeing those earnings trends start to shift. You've seen more sustainable evidence of that within large caps, that the earnings for the other 493 are picking up versus slowing for the Mag 7, which are also investing heavily in capex. And so that story is there for small caps as well, but it's just taking longer to play out, and we're not seeing as much evidence of it. So, I think if we do see soft landing, no recession, and if the small cap earnings data can improve, then that rotation may likely continue, especially if we're in an environment of Fed cuts, given all of the refinancing risk for the Russell. So near term, bottom line, we'd still think there's opportunity within pockets of small caps, particularly those that are higher quality, have been able to beat and raise, see upward estimate revisions. But for the Russell 2000 overall, we think it may be a challenging period. Volatility also typically picks up in this period, especially in election years. So owning quality and sticking with large caps for the near term may be more prudent.
Yeah, I was going to say, so I'm looking at the VIX, it's a 26, far cry from 60, but also far cry from 12. If we're in a more consistent, higher volatility regime, that's U.S. tech large cap, yeah?
Large cap over small and really quality. I mean, when we look at what's been consistent when volatility picks up, just stocks that have stable rather than volatile earnings have been a very consistent outperformer in those environments where the VIX picks up. I think for large caps, we've been more cautious on tech relative to some of the other sectors. Mag 7 stocks have been relatively more expensive and over-owned by fund managers versus some of the other cyclical areas. I think even if we're in a slowing macro environment, we still expect a capex cycle in the U.S. We have a lot of aging and crumbling infrastructure. We have reshoring. So even though capex is something that's usually cyclical, there may be more of a case for a capex cycle this time around. So, we still think that a rotation is likely, but near term, if there are concerns around a slowdown, we think sticking with high quality stocks, it makes sense.